Something weird is happening in the housing market. This could potentially hike mortgage rates to levels that we haven't seen since 1970s and 1980s. Everybody for some reason believes that if the Fed is going to lower down interest rates, then we are going to have lower mortgage rates. But that's not how it works, and it's not going to happen. So even if the Fed is going to lower down interest rates, mortgage rates are not coming down for the reason that I will explain here in this video. So if you're ready, give this video a thumbs up and let's find out when mortgage rates will finally come down. This is how people believe the housing market works. You go to a bank and you borrow a mortgage. So for the bank to provide you with a lower mortgage rate, then they must borrow that money from the Fed at a lower interest rate. So it all comes down to the Federal Reserve. But this is not how the banking system works. The banks work in such a way that they borrow money from investors at a certain interest rate, let's say 5%, and then they loan it to consumers at a higher interest rate, let's say 8%, and pocketing the difference. In fact, if you look at the numbers, on average, they borrow 50 times more money from investors than the Federal Reserve. And the Fed only exists there in order to stabilize the market and not provide them with free money. So if you want lower mortgage rates, then the banks should somehow convince the investors it's safe to invest and loan your money at the lower interest rates to the banks. But even if you convinced or manage to do that, then you have to understand that 30-year mortgages are extremely risky. This is not the kind of investment that anybody would want to make because you don't know what's going to happen in 30 years from now. Another pandemic, another recession, another depression, massive devaluation of the dollar, you name it, it doesn't matter. That's why banks would never want to provide you with a 30-year mortgage. So the question is that how on earth did the banks keep providing them for so many years? It makes no sense. When the banks create and give you the 30-year mortgage, they turn them into mortgage-backed securities, bundle them under one giant security, and then sell them to investors, and they're backed by the government of the United States. So the banks do not hold your mortgage. When you make your mortgage payments, you're not paying the bank, you're actually paying the investors who purchased the mortgage-backed securities. So the rates on the mortgage-backed securities determine your mortgage rate. And the only reason that investors would want to buy mortgage-backed securities is because they're being backed by the government of the United States. Well, if this is the case, then how did we have 2 or 3% mortgage rates back in 2020? Because if you think about it, nobody would want to buy a mortgage-backed security or any kind of security and lock his money for the next 30 years only receiving 3% interest, because by the time you're going to get your money back, it's going to worth absolutely nothing. Then 2020 and 2021 absolutely debunks that idea. But to answer that question, you have to take a look at the balance sheet of the Federal Reserve. This is how much mortgage-backed securities the Federal Reserve holds in its balance sheet or its disposal. Prior to 2008 financial crisis, the Federal Reserve did not hold any kind of mortgage-backed securities because the Fed was not involved in the housing market. Everybody thought that the housing market is very stable and the house prices will continue growth forever. But the 2008 Great Recession proved that's not the case, and even the housing market can collapse. So when it collapsed and we realized that if the Fed does not step in right now and saves the housing market, it will keep dragging the entire US economy and therefore the global economy down. So they step in and they start buying mortgage-backed securities. And that's why if you look at the balance sheet of the Fed, you instantly see a huge hike that they bought trillions of dollars of mortgage-backed securities. This is what drove interest rates on the mortgages down and down. And it did not happen instantly. Because if you go back to 2008, nobody is buying mortgage-backed securities. So interest rates on the mortgages are super high. And then the Fed steps in and starts buying them, which that huge demand for the mortgage-backed securities by the Fed artificially lowers down mortgage rates. In 2012, you see another hike when the Fed started buying mortgage-backed securities. And if you compare that to what's happening to the interest rates on 30-year government bonds, they kept going down as well. And that's why in 2020, there was another hike. When the COVID pandemic happened in 2020, the Fed realized that they got their lessons from 2008, and they realized if we don't step in right now and start buying massively mortgage-backed securities, the entire economy has the potential to collapse. So instead of waiting for the collapse, we are going to take massive action now. So the Fed steps in and starts buying these mortgage-backed securities in trillions of dollars, as you can see in the balance sheet of the Fed. And this is what drove mortgage rates to such a low rate in the first place back in 2020 and 2021. But here's the interesting part. In 2022, the Fed realizes that, wait a second, we are in trouble because we cannot possibly manage to keep buying mortgage-backed securities. This is unsustainable for the economy. This is unsustainable for the housing market. In fact, it's destroying the housing market. So we have to get rid of these mortgage-backed securities. During crisis, nobody would want to buy them. But now we have them in our balance sheet. The crisis is over, and now we'll start selling them to investors. And that's why if you look at the balance sheet, they started selling their mortgage-backed securities, and they have already dropped it from around $2.8 trillion up to $2.3 trillion. And that's why mortgage rates since then have skyrocketed. Why? Because there is an oversupply in the market of mortgage-backed securities, and there is not enough demand on the other hand. That artificial demand in 2020 and 2021 was created by the Fed. Now here is the real problem. Fed jumping in and buying mortgage-backed securities is equal to the same thing as the Fed buying that house. You are not buying that house. You're only putting a down payment to buy the house. And then because the Fed prints the money and buys that house on behalf of you, it's creating money out of thin air. And that leads to massive hike prices. So house prices keep rising. That is unsustainable trend for any country or for anybody. And that's why if you look at house prices are rising so much over the last 50 to 60 years. Back in 1970s, 3 household income would get you a house. In 2025, 6 or 7 household income would get you a house. So if this trend would continue, maybe in 5 to 10 years from now, you might need 10 to 12 households to buy a single house. Is that good for American people? Is that good for the housing market? No. So we have to massively sell off all of these mortgage-backed securities to the investors so we restore the faith and the confidence in the housing market, and the housing market or the house prices do not keep rising so much. And that's exactly what they started doing. And they will sell the mortgage-backed securities to investors. The question is that who are the investors who are going to buy the mortgage-backed securities? And this is the lens that investors look at any investment. So the more risk you take, the more reward you expect out of your investment. And if this is a startup that has massive risk, you expect a potential to make 1,000% out of it. If you are buying a house, it's a very safe investment, then you are expecting a very low return on your investment. So investors have multiple options to invest. The safest investments that we have in the market are called treasury bills. Currently, 10-year treasury bills provide you with a 4.5% interest rate. So you're buying or loaning money to the government of the United States. So in the financial markets, we believe that this is the safest investment that you can possibly get. So if you're getting on that 4.5%, and this is almost risk-free, then if you are investing in mortgage-backed securities, you are taking some level of risk. Especially the 2008 financial crisis proved to everybody that the housing market is vulnerable. So you're expecting a slightly higher return from the treasury bills, let's say by 1 to 2%, or that is probably around 6 to 7%. Because if mortgage-backed securities would provide also 4.5%, then investors would always choose treasury bills over mortgage-backed securities. So to attract investors, you have to provide with a slightly higher return. You also have an option to invest in index funds that provide you with a slightly higher return of 7 to 10%. An index fund is basically a financial institution that invests in the stock market. Now, the stock market is slightly more riskier than the treasury bills or the housing market because it actually involves a lot of elements of risk. These are businesses, they create products and they sell them to people. And today there is demand for these products, tomorrow there isn't a demand. But because index funds invest in a wide variety of businesses, the risks are very low. Since if one business goes down, another business is going to rise. Take the S&P 500 that invests in the largest 500 companies in the United States. What are the chances of the top 500 companies to go down? Pretty much to zero. And that's why you're not getting astronomical returns, but you're getting much more than you can get from real estate, and especially by providing your money to or investing in the US government debt. Besides that, we have individual stocks. But if you decide that you don't want to go into the index funds and you want to go into one single stock, then you think about that company. If it's a very risky stock such as Palantir, you're expecting 100%, 500%, 700%. If it's Nvidia, same thing. You're expecting a very high return. But if it's a blue chip stock such as Apple, then you can get 20%, 25%. So a rough idea is that you're expecting at least 10% or more than that, since you are avoiding a mutual fund and investing in individual stocks. Again, before you invest into individual stocks, you must do your analysis, you must know your valuation, and you must know what kind of a risk you're taking, and you must know what kind of investment you're making. And that's why if you're unsure about these investments, either go with the super safe investments, but if you are really good at investing and finding out valuations and know how to analyze stocks, then you can go with individual stocks. Before you do that, again, make sure that you have the right skills. You can make a lot of money out of it, but if you are foolish about it and you don't have really great skills, you don't know valuations, then chances you lose your money is as much as 90% of the people who lose their money in the stock market. Let's get back to the mortgage-backed securities. Who are the people who invest in mortgage-backed securities? The first type of people are institutional investors. These are huge financial institutions. We are talking about pension funds. We are talking about insurance. So if you're a pension fund, you cannot go and invest in the index fund. You cannot invest in the stock market. Why? Because you have to pay pensions. You need a consistent cash flow into your business. You are a huge business, people paying you payroll tax. You have to be super, super safe. Ideally, you would go with the treasury bills of the United States. But to diversify your investment, you would slightly go into mortgage-backed securities since they provide you with a slightly higher rate of return than the treasury bills, which is why some of these or a lot of these institutional investors would invest in mortgage-backed securities. You have banks, JP Morgan, or investment banks. A portion of their income or a portion of their assets would go directly into mortgage-backed securities for the exact same reason. They need to make sure that a portion of their portfolio is invested in a super safe investment. It goes into the treasury bills first, and then a portion of that goes into the mortgage-backed securities since they provide you with a slightly higher return. And you also have foreign investors who also make a huge portion of the investors who are investing in the mortgage-backed securities. Why? So you have the United States and you have the entire world. And the US is this stable, capitalistic utopia where you can make a lot of money. Like there isn't a place on the face of the earth that you can make as much money as the US and is as stable as the United States. And the housing market is the backbone of that economy. So you have people in Europe, Australia, China, the rest of the world. They're like, we want to invest in the housing market in the US. But it's very difficult to get into that because the real estate market is brutal. You know, I am in the real estate market. It's so brutal to deal with all of these houses, tenants, and a lot of other things. So you don't want to get into that. But how do you invest in the housing market? By simply buying mortgage-backed securities. So these are the three types of investors who are mostly buying mortgage-backed securities. So here's how your mortgage rate is being determined by them. If there is very high demand for these mortgage-backed securities, because everybody wants to invest in them and buy them, then your mortgage rates will be lower because everybody wants to loan you that money. Everybody wants to invest in the housing market in the US. But if vice versa happens and the demand for the mortgage-backed securities goes down, then you will have a much higher mortgage rate. It's as simple as that. That is what actually determines your mortgage rate and not the Fed, even though that the Fed has massive power over it. But the Fed right now on a mission to lower down its balance sheet by $35 billion every single month. The Fed wants to take this balance sheet of trillions of dollars of mortgage-backed security that it has right now at its disposal and wants to sell them to these investors. Foreign investors, here you go, buy these mortgage-backed securities. Pension fund, the funds that invest in like the social security funds or pension funds in other countries, or you have insurance companies who also need consistent cash flow. Buy them. But what they've realized is that nobody wants to buy $35 billion worth of it every single month. The real scenario happen is that they only could sell something between $15 to $20 billion because there is a very weak demand for mortgage-backed securities. And if that demand is not going to strengthen, then mortgage rates are not going down, even if the Fed lowers down the interest rates. Now, there is the biggest problem with the mortgage market. On one side, we have foreign investors who invest literally billions of dollars into the housing market in the US. But the United States currently trying to devalue the dollar. Over the last 6 months, the dollar has been devalued by around 13%. The question is that, how does that impact the housing market? So you have a foreign investor, let's say European Union, countries in the European Union, want to invest in the housing market in the United States. And they are making their returns in dollars. And then they convert those dollars into the euros, let's say to Germany. And that is the real return that they have made. Let's say hypothetically that the exchange rate between the United States and the European Union is 2 to 1. So 1 euro is equals, or $1 is equals to 2 euros. So if this German pension fund that invested in the mortgage-backed securities in the United States and made $100, they take that $100, bring it to Germany, and because exchange rate is 2 to 1, $100 is equal 200 euros. They're very happy with that investment. Now, let's assume everything is the same and we have devalued the dollar by 50%. And now $1 is equals not to 2 euros, but $1 is equals 1 euro. And now let's assume that we're still gonna make the exact same $100 in the United States. And then we bring this $100 to Germany. Now, because exchange rate is now 1 to 1, the $100 in Germany is equal 100 euros. Yes, we still made the exact same $100 in the United States, but because the dollar has weakened, the real return that the foreign investors got out of the United States have gone down. That's why a weaker dollar discourages people from investing in the United States. And if the mission of the current administrations to keep devaluing the dollar, that's exactly what they said. I'm not putting words in their mouth. I'm not coming out with some of my own ideas. This is literally what they're trying to do. They said that the dollar is too strong and we have to weaken it, which is going to slowly keep pushing or keep driving out foreign investors from investing in the mortgage-backed securities, which will weaken the demand for them. Second problem is that if the yields on the government bonds will rise, then the rates on the mortgage-backed securities will rise, which are going to increase your mortgage rates. And over the last 5 years, they have been growing. Now, government bonds are the debt that is created by the government. And here is the biggest problem. What you need to understand is that what determines the yields is the supply and demand in the market. So let's say there is 100 supply and there is 100 demand. So we have a very stable market. Suddenly, if you have too much demand, too many people want to buy government bonds, then the yields on the government bonds will go down because the demand is strong. And vice versa. If the demand is at 100 and suddenly you inflate or oversupply the market with too many government bonds, you have to increase the yields for the demand to catch up. And if the yields on them are going to grow, then the yields on the government bonds or the yields on the mortgage-backed securities will also have to rise, since they have to be at least 1 to 2% higher to attract the investors. And now, because the national debt is growing so fast, and the deficit is growing so big, and they have passed the One Big Beautiful Bill, which means that the deficit will grow even bigger, which means that the national debt will grow even bigger. By some estimates, it's around $4 to $5 trillion, maybe even more than that. We still have no idea or whatsoever. We're gonna see, but at least these are the lowest estimates. That means that from now onwards, the government will be creating even more government bonds, which means that the supply of bonds in the market will keep growing. And if the demand is going to not catch it up, which is how it seems right now, the yields on the government bonds will keep rising, which is going to keep mortgage rates higher and higher. And these are the two fundamental problems that are in the market right now that could potentially or most likely keep rising or keep the interest rates or the mortgage rates high even if the Fed lowers down the interest rates. And this is the problem right now with the housing market. I hope you have enjoyed this video, and I hope I have oversimplified the entire video. Don't forget to check the links in the description of this video if you're new to investing and if you want to make your first $100,000 in the stock market. This might be probably one of the best times to start investing, especially with everything that's happening with the economy and the stock market. Thanks for watching, and I will see you in the next one.